In the tumultuous wake of the 2008 financial crisis, as housing markets cratered and foreclosures spiked across the nation, a unique opportunity emerged for the bold and the prepared. While many investors retreated, paralyzed by uncertainty, others recognized a rare window for unparalleled acquisition. Imagine the challenge: acquiring a foreclosed property, sight unseen, in a market where every headline screamed doom. This was not merely a risky proposition, it was a calculated gamble demanding an entirely new approach to due diligence and risk assessment. We will explore the compelling narrative of one such investor who navigated this treacherous landscape, transforming a distressed asset into a cornerstone of their portfolio. Paragraph 1. Problem Opportunity, Investor Mindset. In the tumultuous wake of the 2008 financial crisis, as housing markets cratered and foreclosures spiked across the nation, a unique opportunity emerged for the bold and the prepared. We will explore the compelling narrative of one such investor who navigated this treacherous landscape, transforming a distressed asset into a cornerstone of their portfolio, offering invaluable lessons for today's market fluctuations. Paragraph 2. Success Case Study, Investor Mindset. Our focus centers on an investor, let us call him Marcus, who, despite lacking the ability to physically inspect a promising foreclosed property in a mid-sized Midwestern city, proceeded with its acquisition. This decision, made at the nadir of the market, defied conventional wisdom. Marcus understood that extraordinary circumstances often yield extraordinary returns, but only for those willing to embrace meticulously structured risk. His story is a testament to the power of rapid, data-driven decision-making when traditional avenues are closed, illustrating how a blend of conviction and analytical rigor can unlock significant wealth even in the most volatile environments. Paragraph 3. Market Analysis, Strategy Explanation. The period between 2008 and 2010 witnessed a dramatic surge in foreclosed property inventory. According to data from RealtyTrac, foreclosure filings peaked in 2010 with over 2.8 million properties receiving a foreclosure notice, representing a nearly 23% increase from the previous year. This unprecedented volume created an imbalance, pushing prices down and offering deep discounts to cash-ready buyers. For investors like Marcus, these distressed assets represented a chance to acquire properties significantly below their intrinsic value, a fundamental principle of value investing that rarely manifests on such a grand scale. The market crash, while devastating for many homeowners, paradoxically created a fertile ground for strategic real estate acquisition. Paragraph 4. Risk Assessment, Actionable Step. The phrase sight unseen immediately flags a profound risk in real estate. Without a physical walkthrough, an investor cannot assess structural integrity, deferred maintenance, code violations, or potential environmental hazards. These unknowns can swiftly erode profitability, turning a seemingly lucrative deal into a financial quagmire. But here's the catch. In a fast-moving foreclosure market, many properties are sold as is and often without interior access, especially at auction. Marcus recognized that mitigating this inherent risk required an intensified, almost forensic approach to remote due diligence, a process far beyond standard practice. Paragraph 5. Actionable Step, Strategy Explanation. Marcus's rapid due diligence began not with a visit, but with a deep dive into publicly available data. He meticulously analyzed tax records, county assessor sites, and online mapping services to gather every possible detail about the property. Satellite imagery provided clues about the roof condition, lot size, and surrounding neighborhood. Local police reports and crime statistics offered insights into the area's stability. More critically, he engaged local real estate agents and property managers, not for access, but for their granular knowledge of the specific street and block. These professionals could often provide anecdotal information about previous occupants, typical property conditions in the area, and even recent sales comparables, painting a clearer picture of the asset's potential state. Paragraph 6. Financial impact. Strategy explanation. With this aggregated data, Marcus moved to financial modeling, a non-negotiable step for any serious acquisition. He calculated potential rental income based on comparable properties, then conservatively estimated renovation costs, always padding for unforeseen issues given the sight-unseen nature. His core metrics included the capitalization rate, or cap rate, which is the ratio of net operating income, NOI, to the property's asset value, indicating the rate of return expected on a real estate investment property. He also focused on cash-on-cash return, which measures the annual before-tax cash flow against the total cash invested, and return on investment, or ROI, a broad measure of profitability. All projections were stress-tested against worst-case scenarios, ensuring that even significant unexpected expenses would not render the investment entirely unprofitable. This rigorous financial scrutiny served as his primary safeguard against the blind purchase. Paragraph 7, Challenge overcome, financial impact. Securing financing during a market crash posed another significant hurdle. Traditional lenders tightened their criteria, demanding higher down payments and scrutinizing asset quality with unprecedented rigor. Many banks were still reeling from their own exposure to defaulting mortgages. Marcus, anticipating these challenges, had cultivated relationships with local community banks and private lenders who understood the distressed asset market and were more agile than larger institutions. He presented a meticulously prepared business plan, emphasizing his conservative financial projections and the deep discount at which he was acquiring the foreclosed property. This proactive engagement, coupled with a strong personal financial position, allowed him to secure a non-recourse loan, protecting his other assets should the investment falter. Paragraph 8, Legal consideration, success case study. The actual acquisition unfolded through a county auction, a common venue for foreclosed properties. This process is inherently complex, laden with specific legal requirements and timelines. Marcus had retained an attorney specializing in real estate law, particularly foreclosure proceedings, to navigate the intricacies of the title search and ensure there were no hidden liens or encumbrances that could jeopardize his ownership. Acquiring a foreclosed property often means accepting it with existing issues, known as caveat emptor or buyer beware. His legal team performed an exhaustive title examination, a critical step to guarantee clear ownership post-purchase. On the day of the auction, with a predefined maximum bid based on his stringent financial analysis, Marcus successfully acquired the property. Paragraph 9, Challenge overcome, investor mindset. The moment of truth arrived with the first physical inspection. Stepping inside the foreclosed property, Marcus faced the raw reality of his sight-unseen gamble. The house was in disarray, with evidence of neglect and some vandalism. Missing fixtures, damaged drywall, and an overgrown yard confirmed the need for substantial work. While the structure was sound, a critical finding was a severely damaged HVAC system and a leaking roof, issues that his remote due diligence could not definitively uncover. This initial assessment, though sobering, fell within the contingency budget he had prudently allocated, underscoring the value of conservative financial planning for distressed assets. Paragraph 10. Actionable step. Challenge overcome. The next phase involved a strategic repair and renovation plan. Rather than aiming for luxury finishes, Marcus prioritized functional improvements and high-impact upgrades that would appeal to the target rental demographic. The leaking roof was immediately addressed, followed by the HVAC system replacement. Cosmetic repairs such as fresh paint, new flooring, and updated kitchen cabinets were chosen for their durability and cost-effectiveness. He leveraged a network of trusted contractors, negotiating fixed-price bids where possible to control costs. This disciplined approach to renovation ensured that the property would be market-ready efficiently, minimizing holding costs and maximizing its rental appeal without overcapitalizing. Paragraph 11. Challenge overcome. Actionable step. Bringing a newly renovated property to market during a housing slump presented its own set of tenant acquisition challenges. Unemployment rates were elevated and many potential renters had tighter budgets. Marcus recognized that aggressive marketing and a robust tenant screening process were paramount. He utilized online platforms and engaged a local property management firm to handle showings and applications. The screening process was rigorous, including credit checks, employment verification, and previous landlord references to mitigate the risk of future defaults. His goal was to secure reliable, long-term tenants, even if it meant adjusting initial rent expectations slightly to ensure consistent occupancy. Paragraph 12, actionable step, financial impact. With a qualified tenant secured, the property transitioned into a stable rental asset. Effective property management became crucial for optimizing returns. Marcus implemented systems for timely rent collection, proactive maintenance, and clear communication with tenants. He closely monitored the debt service coverage ratio, or DSCR, which measures the cash flow available to pay current debt obligations, ensuring that the property's income consistently exceeded its expenses, including mortgage, taxes, and insurance. This vigilance protected his investment, allowing the property to generate steady passive income. The initial risk had now been converted into a tangible income-producing asset, demonstrating the potential for cash flow even in a recovering market. Paragraph 13, market analysis, investor mindset. As the broader economy slowly began its recovery, Marcus observed the gradual stabilization of the real estate market. Property values, which had plummeted during the crash, started to appreciate. This upward trend was not uniform, but his strategic acquisition during the downturn positioned him perfectly to capitalize on the rebound. Experts at the National Association of Realtors later confirmed that the median existing home price began a steady climb in 2012, signaling the end of the market's deepest slump. His decision to buy when others feared to tread proved prescient, validating the contrarian investment philosophy that often yields the greatest rewards. Paragraph 14, strategy explanation, financial impact. Over the subsequent years, Marcus continued to optimize his investment. As the property appreciated, he explored opportunities for a cash-out refinance to pull equity out, which he then deployed into other income-producing assets, effectively leveraging his initial success. He also considered a 1031 exchange, a powerful IRS provision that allows investors to defer capital gains taxes when selling an investment property and reinvesting the proceeds into a like-kind property. This strategy is instrumental for long-term wealth building, enabling investors to continuously grow their portfolios without immediate tax burdens, further amplifying the returns generated from that initial sight-unseen acquisition. Paragraph 15, investor mindset, actionable step. The lessons learned from this high-stakes acquisition are profound and universally applicable. First, diligent, unconventional due diligence is paramount when traditional methods are unavailable. Second, conservative financial modeling, including robust contingency planning, is the investor's best defense against unforeseen challenges. Third, cultivating strategic relationships with local experts and alternative lenders can unlock opportunities inaccessible through conventional channels. Finally, market timing, while inherently difficult to predict with absolute certainty, rewards those who possess the courage and foresight to act decisively during periods of extreme market dislocation, always balanced with a realistic acknowledgement of risks. Paragraph 16, financial impact, investor mindset. Marcus's journey from a risky sight-unseen acquisition to a profitable rental asset underscores a fundamental truth about real estate wealth building. Resilience and meticulous preparation can transform even the most daunting market conditions into fertile ground for growth. For aspiring and current investors, this case study serves as a powerful reminder that tangible assets, carefully acquired and strategically managed, offer a robust pathway to financial independence. The capacity to identify value amidst chaos, coupled with an unwavering commitment to detailed execution, remains the definitive hallmark of a successful real estate investor.